Parker Asset Management was named the best performing fund manager of the year last year by Mercer. And joining us here now is Philip Parker, the founder and managing director of Parker Asset Management. We thought we'd pick his brains in these volatile times to tell us about the secrets of their success. Philip, thanks for joining us.
Thank you very much.
So Philip, you're the guy to ask. What companies and sectors should people be looking at for the rest of the year and into 2013?
Okay, so towards the end of calendar year 11 and the beginning of calendar year 12, we started to focus more, end of last year, particularly on resource support companies. We'd had some stocks in the portfolio for quite a while, but then we also added to some ones that we really liked after the reporting season.
It sounds like you're heavily leveraged to the mining services sector and infrastructure. Is that fair to say?
That's a very fair assessment, Jeff. It's funny, on a trip I did to Narrabri about a year ago, I was talking to one of the guys who was a plant manager at a business that we didn't buy into. But what I learnt was that win, lose or draw, at the mining end, the guys supplying the parts were just making a fortune. It got me thinking, who's supplying the valves, who's supplying the pumps, who's pumping the water, who's building the new sites? Because I think if you look at assessments, there's about $42 billion of spend coming in the next 18 months in the resource sector. Now, some of the resource companies will be affected by commodity prices. That's another story. But the people supplying the infrastructure and the parts for this industry are going to make money, win, lose or draw. So it's been an ongoing theme for us, and Tim Reardon, who works with me, has been spending a lot of time looking at the companies, as have I, on the road, and we've found some very interesting businesses. We've found a company that just pumps water, for instance, which we're very keen on.
How do you go about choosing the companies?
My background as a value investor, so I'm really interested in companies that have got a history of very sound earnings. And if we can't see that history, well, we want to go and understand what the business is doing if it's a newly listed company. So to give you an example of that, to answer your question, we discovered a company in December 2010. And basically they just did corporate travel. That was their business. And corporate travel management's the exact name. All they care about was the travel industry. And here was a business that was listing, with the $70 million market cap. And, you could buy, they had money at the bank, cash at the bank. You could buy the whole business for 50 odd million. And they were going to do 13 million in 2011 fiscal year, which they've done, EBITDA. And for this year, 12, they're going to do 16. So you're buying the business on 3.5 times enterprise value to EBITDA. So a very cheap multiple when you take the value of the company, deduct the cash, and then divide the earnings into it. So we got really interested. So we met them at a conference in Brisbane. We then met them in their site here in Margaret Street, Sydney. We also, in those two visits, we learnt that no one customer represented more than 5% of their EBITDA, and that they only had 7% of the market share. And they were buying cheap businesses at less than the multiple on their business, and then bringing them into their sort of IT integrated world with motivated young sales staff. And they've grown that business significantly. So they're now about 8-9% of the market from 5 to 6% of the market. We think they're going to grow to probably 15% of the market. We bought them at $1 share price, but we bought, it was 50 odd million. They're now trading at sort of $2.
Do equities make sense anymore for retail investors?
Yeah, I'm positive of it. And I'll tell you why. And it might be something that they would like to look up. There's a report that's done every year in February by Credit Suisse and the London School of Economics. And what it does, it's a very simple report in the sense of what it's achieving. It looks for equities versus bonds versus bank bills. And it looks for the comparison of if you'd put $1 in, or a euro, or whatever the currency is, in each of these different economies that have these things, very sophisticated markets. 100 years of data, 110 years of data, and it's shown that over 110 years, Australia, to give you an example on Australia, $1 invested in the All Ords, the ASX 300, or whatever they call it now, has grown to $2,800. $1 invested in 10-year bonds, just rolled over for 110 years, is now worth $4.70, so you've 5 times your money, and $1 in bank bills is about $2.70. And if you look at different economies, you look at the next best economy, funnily enough, in its results across the board, South Africa. So $1 in equities, a rand in equities, is now worth 2,100 in its own currency. And then bank bills and bonds are similar to the Australian experience. Then you get countries like Canada and so on. So you get the theme. Equities in countries that have got a natural resource where they've got a bit of an added advantage do extremely well. But the big thing is if you're in there, you get massive outperformance. 2,800 times your money on equities for maybe 2 generations of a family, versus 5 times your money in a bond. That to me is the salient point. Now, I don't believe, having said that, I don't believe in set and forget, right? Because people get freaked out if the market falls 20, 30%. I think Warren Buffett said if you can't hold a stock and it falls 50%, you shouldn't be in the stock, because he's taking the long view. I take the same view, that you want to be in companies for the long run, but at the end of the day, if things are cyclically expensive, you've got to sell out, move to cash and wait for that to turn and then reinvest again.
All right, time to make a call at the end of the year. Where's the ASX?
I never make predictions like that, Jeff, to be honest with you. What I would think is possibly up from here, but not by much. Volatile after June, but not too volatile into June. And that's the way we're sort of playing it. So we kind of like volatile markets because we can take advantage of big moves in stocks. We can buy companies that are being beaten down, or we can sell companies that are being raised up. If I had to put a number on it, I probably think it might get to 4,500. But I'm not going to back the house on that. We're not about that sort of thing. We're about picking undervalued stocks and then using overvalued markets to protect the portfolio. That's all.
Philip Parker, it's been a real pleasure. Thanks for your time.
Thanks a lot. Nice to meet you at last.